So, something really interesting just happened on Wall Street. After a pretty quiet summer, some of the world's biggest investors suddenly started pouring billions and billions of dollars into banks. Today, we're going to figure out why.
And it really all boils down to this one big question. With so much uncertainty floating around, why are some of the sharpest minds on Wall Street suddenly so bullish on the financial sector? What do they know that we don't? All right, let's dive right in. First things first, we need to look at exactly what went down.
Okay, so according to a brand new research note from Goldman Sachs, hedge funds basically went on an absolute shopping spree. And they weren't just browsing. Oh no, they were snapping up shares in banks, insurance companies, you name it, in a huge way.
And we're not just talking about a little blip on the radar here. This was the fastest they've bought into this sector in 3 whole months. A move that was big enough to make pretty much everyone on Wall Street sit up and pay attention.
Now, to put this into perspective, while tech stocks were still the #1 buy, no surprise there, financials just rocketed up to become the #2 most bought sector. That just goes to show you how deliberate and, well, how big this move really was.
And this wasn't just some localized thing either. We're seeing this activity focused in the big leagues, North America and Europe. And the really crucial part, they were taking what's called long positions. Now, in plain English, that's just a direct bet, a huge gamble, that the share prices of these companies are about to go up.
Right, so that's the what. But the million-dollar question is why? I mean, what is driving all this sudden confidence in a sector that's, well, let's just say it's had its share of challenges lately?
Well, according to that same Goldman Sachs note, it really comes down to 2 main things. First, investors are betting on a future with a lot more big deals going down. And second, they seem to be anticipating that government regulations might be loosening up a bit. And you can really feel that sentiment in this quote here from analysts at Panmure Liberum. They were hoping for more pragmatism from the regulators, and their take on it now is, so far so good. That's exactly the kind of optimism that gets money flowing.
Okay, but this is where the plot thickens a little bit, because there's this one piece of the puzzle that seems like it just doesn't fit: interest rates.
You see, we all know that banks typically make more money when interest rates are high. It's just how their business model works. But right now, the U.S. Federal Reserve is doing the exact opposite. It's cutting rates. So why on earth would hedge funds pile into banks when the whole environment seems to be getting less profitable for them?
Well, it turns out the answer is actually pretty simple. This wasn't a surprise, not at all. There's a saying on Wall Street that news gets baked into the market, and that's exactly what happened here. Everyone already expected lower rates, so it was already reflected in the stock prices. The actual announcement didn't cause a panic.
And to be fair, the Fed has been really transparent about all this. I mean, they made a cut last week, and then they clearly signaled that more cuts are probably coming in October, and then maybe again in December. When you communicate that clearly, it gives the market months to adjust, and it totally removes that element of shock.
Now, it's really important to understand that this huge bet on banks isn't happening in a vacuum. It's actually part of a much bigger shift in how the whole market has been behaving lately. Think about it. August was pretty quiet, right? Trading levels were down. It felt like everyone was on vacation. And then suddenly, last week, it's like a switch was flipped. They came roaring back, ready to make moves, and activity just exploded. And to really get a sense of just how big this surge was, we need to talk about a key term investors use: gross leverage. Just think of it like a riskometer. It basically measures how much money a hedge fund is actively putting on the table.
And the numbers here are, well, they're pretty striking. Just last week, hedge funds cranked up their gross leverage by the largest amount we've seen in 8 months. It's a crystal clear signal that their appetite for risk is back and they are putting some serious money to work.
And what really ties this all together is this quote from the CEO of Goldman Sachs, David Solomon. He confirmed that the market for IPOs, initial public offerings, is heating up big time. And that signals a really active environment for deals, which, if you remember, was one of the key reasons investors were jumping back into banks in the first place. It's all connected. So, we've looked at the what, the why, and the wider context. What's the one big thing you should take away from all this? What does it all really signal?
At the end of the day, this big move into banks isn't just a story about one industry. You should think of it more like a barometer for the entire market. It seems to be screaming that big money investors are feeling more confident and are way more willing to take on risk because they believe there's profit to be made out there.
Which, of course, leaves us with one final and pretty fascinating question. Is all this new confidence a genuine sign of a healthy, recovering market that's ready to take off? Or could it be something else? Could it be that final feverish rush of excitement right before a big downturn? For now, I guess only time will tell. Thanks for tuning in.